Hi, today we're breaking down something every business owner needs to understand: depreciation. It's one of those accounting terms that sounds complicated, but it's really just how we spread the cost of big assets, like equipment, vehicles, or machinery, over time. So let's go over what it is, how it works, and why it matters for your taxes and financial reports. So, what is depreciation? When your business buys something expensive, say a delivery van for $40,000, you don't expense it all at once because that van will last years. Instead, you expense a portion of it each year. That's depreciation, a systematic way to spread the cost of an asset across its useful life. So, if that van lasts 5 years, you might record 8,000 of depreciation each year. Simple as that. But why does depreciation even matter? Well, it matters for two big reasons: financial reporting and taxes. Financial reporting gives you a more accurate picture of profit. Without depreciation, your expenses would look huge in one year and unrealistically low after. Taxes. Depreciation reduces your taxable income, meaning you pay less in taxes. The IRS lets you write off assets gradually, or sometimes even faster, using things like Section 179 or bonus depreciation. Now, here are some common ways to depreciate your assets. There's the straight line method. That's the same amount each year. Then you have the declining balance method. That's more depreciation in the early years, less later. This matches how some assets lose value faster upfront, like cars or electronics. Then you have the units of production. That's based on usage, perfect for manufacturing equipment or vehicles that wear out by miles or hours used. Most small businesses use straight line depreciation for simplicity and consistency. Now, you might have heard of bonus depreciation in Section 179. That's where taxes gets interesting. The IRS allows you to accelerate depreciation, meaning you can write off the entire cost right away. So Section 179 deduction, that's when you can deduct the full cost of qualifying assets in the year you buy them, up to a limit though. Then you have bonus depreciation, that lets you take a big percentage, often 80% or more, immediately. These are huge for small businesses that want to lower taxable income quickly. But be careful, using them means you won't have depreciation expense in future years. So it's about timing and tax strategy. So you might be wondering, how does depreciation affect my books? Well, every time you record depreciation, two things happen in your accounting system. You have a debit to depreciation expense on your income statement. Then you have a credit on accumulated depreciation on your balance sheet. The asset's value goes down over time, while you recognize the cost gradually as an expense. It's non-cash, meaning no money leaves your account, but it still affects profit and taxes. So why does this matter long term? Well, depreciation helps you shows realistic profits, plan for future equipment replacements, lower taxes legally, keep financial statements accurate for investors or lenders. Ignoring depreciation can make your business look more profitable than it really is, and that can backfire come tax time. So that's depreciation. It's not just paperwork, it's strategy.